Hello and welcome to EduFund. In today's episode, we have a special guest with us, Preeti from UTI Mutual Fund. Preeti joined UTI Mutual Fund in 2012 as a research analyst. In 2022, she took up the fund management responsibilities and is currently the fund manager for UTI Banking and Financial Services Fund. Preeti holds a PGDM degree from IIM Kozhikode. Let's hear from the expert today on what has been the experience in managing the UTI Banking and Financial Services Fund. Over to you, Preeti.
Thank you, Neeraj. Thank you for that introduction, and thank you, Edu team, for having me here.
Pleasure is all ours. So why don't we start with your fund's objective, UTI Banking and Financial Services Fund, and a little bit more background about the fund, on how the fund operates, how do you manage the fund, the process, philosophy, and information around that.
So, Neeraj, given that it is a sectoral thematic, the fund invests in the BFSI sector of the country to capitalize on the structural trends that the country offers and also the cyclical tailwinds, basically to meet the fundamental objective of generating alpha over the benchmark. So having said that, if you see, our significant exposure in the fund is on the credit theme, so both retail and the industrial advances, if you can say. So on the retail, so if you see, there's a change in terms of the generation that we're seeing over the last 2 decades, how our parents' generation thought, how the millennials today think, and how we as adults who are in 30s, 40s, how we are thinking about investments and our finances. So there is definitely change, and banking as a sector, or banks as a sector, are definitely capitalizing on this trend. So savings was quite integral to our parents' generation, but for the upcoming generation, both investments in self, which would mean probably investing for certain experiences or investing for future in terms of their education. I think that is quite core to the current generation, and as well as in terms of consumption. So I think the current generation is not shying away from consumption. So that's a great place to be, and with right checks and balances, it's a great theme to play. And if you see, in terms of the franchises that we have today, they are completely homegrown franchises. Prior to 2000, there were a lot of foreign banks who were trying to build a footprint in India. But if you see the top 10 banks, in fact, the entire lending space is dominated by the solid homegrown franchises that you see all around the country. So I think that's a great story for the credit segment in the whole BFSI space, and it's just bigger. So if you look at our credit to GDP, it's still less than 60%. So we have a long way to grow as we build this country, especially in terms of, let's say, the focus, the way the current government is focusing on the manufacturing for self and manufacturing for the world. I think that will definitely take us places, and the ultimate beneficiaries will be the banks.
Right. So as we know that Banking and Financial Services Fund was incorporated in 2004, and it's going to complete 2 decades next year. So what has actually changed over the last 20 years in the fund management process, philosophy, and the style?
Right. So it is indeed a great moment that we get to celebrate the 2-decade journey of this fund. So over the last 2 decades, as you can imagine, we have seen multiple crises, both financial and health crises like COVID that we have seen. It's been a great learning curve. So I think over this period, we have actually made our investment process stronger. While it is a sectoral fund, we continue to be guided by our core alpha model, wherein we continue to be invested in our structural portfolio holdings, or you can say core holdings, which pretty much are in the tier 1, if you can say R1, where they have generated consistent returns much higher than the hurdle rate through the cycles, through the periods. While given that it is a sectoral thematic, we also look for opportunities where we can get companies, which are in R2 or R3, and they can graduate to R1. And when that happens, those stocks actually make disproportionate returns because they get benefit from the earnings recovery and as well as the valuations re-rating. So I think that's something which comes from the investment philosophy of how the fund house itself is run, and that applies to the sector fund as well.
Right. A little bit on the, your style of selecting the funds, selecting the stocks. So what kind of style would you implement? Would it be a value style? Would it be a growth, or would it be a blend of both?
So given it is a sectoral fund, so it has to be a blend because the opportunities are limited compared to, let's say, larger universe, right? So we have fair bit of investments in the growth style and in value style, because I think when you talk about those are 2 or 3 opportunities, well, naturally they happen to be in value category, right? So you are probably looking at some of the turnaround opportunities or cyclical opportunities which are beaten down today, but if you have fair visibility of turnaround, be it on the cycle, be it on the, let's say, things like management change, I think those are the opportunities where you make those investments to benefit from that value names turnaround, and if you're lucky, even that can go into growth. I think typically the growth companies are your core holdings, because the good things don't come cheap, so naturally they tend to trade at higher valuation than the rest of the market or the sector. But there is great visibility in terms of, let's say, the delivery, in terms of growth, or in terms of the returns, right? And most importantly, risk. I think because they have navigated multiple cycles, that itself becomes a testimony to their ability to manage risk. So it's a blend approach to the portfolio in terms of both value and growth stocks.
I think banking and financial services as a sector is very, very dependent on the economic performance. So how would you navigate, or how have you sailed through over the periods of up and down in the last 2 decades?
I think these economic cycles and the business cycles are key, and they are the feature of any business. So it's not necessarily specific to BFSI sector. When it comes to BFSI, the interest rate cycles also play a much bigger role, because money is ultimately the raw material in the business. If you just look specifically at the India interest rate cycle movement, so the volatility has come down substantially. If you just see the last year, the interest rate volatility is much lower, and the sensitivity of the businesses, let's say a bank, when interest rates is down 50 bips or 100 bips, their sensitivity of their performance, be it profits or be it on terms of the return ratios, it's much lower than what it used to be. So I think that is a good position to be. So we have seen last year when US went from 0 to closer to 5%, there was a massive upheaval in the banking sector back in US. So we have actually seen two, three banks going bust. So we have not seen any such movements, any such dramatic movements in India, while we also raised rates by almost 250 bips. So it has been quite well absorbed by the industry. So which means that we also look for those companies which have weathered such shocks in the past. So the history of 10, 15, 20 years gives that opportunity for us to see how various companies have managed such crises and weathered such events, be it economic cycles, business cycles, or even the regulatory reforms.
When you talk about bottom-up stock selection while picking up the stocks in your portfolio, I think if you look at the overall indices, BFSI accounts for roughly the highest chunk, right? Almost to nearly a quarter. So does that create a pressure in the management of the fund when you have a sector fund which is purely focused to that sector? What are your thoughts on that?
So in fact, for any sector to do well, right, I think banking sector gets benefited. It is beneficial because, let's say, if the investments have to go into oil and gas, or investments have to go into a capex intensive sector, be it automobiles, I think eventually the banks get benefited. So the banks as an entity get benefited, be it from a domestic revival, domestic momentum, or even the exports momentum. And irrespective of the investment, is it coming from the government or it's coming from the corporate, right? So ultimately it has to be funded, and the growth is coming to the banks. So that's a positive that I would say that, if the GDP growth is 7%, so the credit growth is going to be a multiplier of that. So if we see the last 2 decades, average credit growth to the GDP, which we call the credit multiplier, is at 1.5 times. So which means that the banks expected to do better than what the underlying economy will do. So in that sense, it becomes a great opportunity to be invested in this sector.
On the fund construction part only, how would you create a fund? I mean, what kind of allocations would you see within the segments of BFSI as an overall sector? We have banking and finance, right. We have NBFCs, insurance and the likes. So what kind of typical exposures would you keep in each of these?
To understand our allocations, or for that matter, any allocation in the sector funds, I think the benchmark is key, because it's a very highly concentrated benchmark. So we do have probably 5 stocks covering 80% of the fund, so, and which is largely into banking. Right, so which means if you look at our fund, even our exposure is 80% to lending, but we would definitely have a strong conviction in certain names, which would mean we'll be overweight certain names and underweight certain names basis our conviction. but 80% of the fund is actually focused on the lending names. So the rest 20% is part of it is insurance, wherein the insurance space has expanded in last 5 to 6 years, where the top 3-4 insurers have come to public. And even in the general insurance, we have 2 or 3 names, and we have more of them coming in. So we are playing that, and as well as the capital marketplace. So we have actually seen a major boost to the capital market, especially in the pandemic. So we're also participating in that theme as well.
When you spoke about the capital market, I think technology has played a very important role in making the entire financial system more accessible to the common man, right? In fact, we are talking about financial inclusion also a lot. And I'm sure that everyone is using UPI to make payments and stuff. So how do you implement technology theme which is changing or impacting BFSI overall while selecting the stocks?
So this mega trend of financialization of savings that we're talking about, I think the sector is going to benefit, not just limited to fintech. So I think in the beginning there were apprehensions that will the fintech disrupt the incumbents. I think the way it has evolved over the last 2 to 3 years is that there's quite regulatory scrutiny on the incumbents, especially when it comes to lending business, right? So that is something that fintechs have now understood, and now they are partnering with the incumbents, right? So now more than competitors today, they are collaborators. There is a healthy cooperation between the fintechs and the incumbents, which I think they both bring certain aspects to the table. The incumbents bring stability to the table, while the fintechs bring agility to the table. So, and they make a great combination for this, financialization of savings to accelerate further from where we are today.
No, I think that's a very valid point. In fact, I think very exciting times are lying ahead of us. On that note, I wanted to understand what would be your advice to our viewers, because often we get questions like, should I do lump sum, should I do an SIP, and markets at 66,000 is very costly. Should I wait for a correction to take a thematic exposure? What would be your advice to retail investors in that scenario?
So our advice has always been to keep the SIPs active. Do not time the SIPs. That's the fundamental purpose of SIP, that you are not actually taking a call on where the market is. So you might think it is low, it could go lower. You might think it is high, it could go higher. So keep the SIPs active, and when some of the fundamental metrics are quite evident or it's out there, I think that's the time when you actually go for lump sum investment. And ultimately it will get actually guided by your investment goals, right? So if we have liquidity requirement in 2 years for a kid's education, or for, let's say, for a wedding, or for any of the purposes that are important to you, then your investment style will also get guided by those criteria as well. But we would never advise to play with the SIPs. I think as the incomes grow, wage inflation and the growth that we're seeing, I think the SIP ticket should also grow from the clients, and they should go all in when they think that markets have actually corrected. I think that's an opportunity which we get once in 5 years or once in 10 years. So last time we had that was in COVID, the crash.
Yes.
So we do not know when is the next time, but we would advise that stick to the SIP.
Any one final advice which you would want to give to our viewers, because considering that banking and financial services is a thematic fund,
right?
What should be their strategy to remain invested in these kind of funds?
Right. So like any mutual fund, even the same principle applies to a sectoral thematic fund, where you have to stick for the longer term. Right, there are no shortcuts to this to this business. Applies to BFSI sector fund as well. I think if we invest over the long term, we would get benefit of both earnings compounding and as well as the valuations re-rating. So we have specifically for BFSI sector today, we have a very fair visibility of at least 15% plus earnings compounding, and the valuations are also at longer term averages. So I think that's a strong visibility that you have for a sector. When you stack it up for different sectors, I think it's one of the strongest in terms of their visibility for compounding that we can see over the next 3 to 5 years. So I would say that that this is a great time to invest and also get the benefit of, let's say, valuation re-rating that could happen, which would be an additional bonus. Otherwise, 15% is a great compounding story for a sector thematic.
Thanks a lot, Preeti, for sharing your valuable insights with us today on UTI Banking and Financial Services Fund. And I hope our viewers has taken some insights on how UTI Banking and Financial Services Fund has been managed.
Thank you, Neeraj, for the opportunity. It was a pleasure being here.